Hello traders, today I want to show you a backtest for a trading strategy and methods that are created by ICT. ICT stands for the Inner Circle Trader. The link to his channel and mentorship playlist is added to the description below. I found 100 setups that matched the strategy and backtested these with the app Trader Edge that I can highly recommend for backtesting strategies. For the initial account size I used 10k. A link to the app can be found in the description. There's also a 7-day free trial available. Check it out. It's great. I added the backtest for the ICT strategy to my library there, in which I stored the results. My stop loss is always 2% of the current account size, which means for every winning trade I multiply the risk to reward of the trade by 2, but we will see this in a moment. Okay, so let's go to the chart. This is Euro USD, the 15 minutes time frame, and I'm going to explain by this example how to take the trades using this strategy. I like to enable the sessions indicator because my preferred session to trade this strategy is London. It has a green background, and when I open the preferences of this indicator, you can see the different times for the sessions. I enabled the session London and New York. London is green and New York is red. Okay, the first thing that we want to see in this strategy is a level of liquidity. This means I'm searching for equal lows or highs, which are zones where retail traders place their orders. So a retail trader would see, okay, this is a zone of resistance. I could place my order here and the stop loss just a tiny bit above because price doesn't want to go higher. But then comes a stop hunt of the institutions that are grabbing the liquidity. You see this here, they stop out the retail traders before they bring down the price. To see this liquidity grab before entering a trade is one of the core things of the strategy. Okay, but before I place my order, I want to see where I can take profit. For this I want to see a pretty good move to the upside, in this case because we want to sell, and in this prior move to the upside, I'm searching for levels to trade into. For example, this one can be seen as an order block, for which we mark the last red candle before the leg to the upside. Another way to search for take profits is to use imbalances that I explain in a moment by an example. Okay, but now for the entry after the liquidity grab. For this I go down to the 2 minutes time frame, and if you like you can use an indicator called fractal break imbalance, fair value gap, and you can use it to see a shift of market structure and, as ICT calls it, the fair value gap, an imbalance to enter the trade. So we see here on the 2 minutes time frame a low that has to be broken, which happens here, and then price comes back to these boxes here, these yellow and red rectangles that mark imbalances. Of course, the higher the price comes, the better it is for the risk to reward ratio. So wait for the price to come up to this zone again. I don't know if it will. If not, okay, there's no trade. But if it does, then we have a pretty good risk to reward ratio, because the stop loss are set to the previous high. Okay, now price comes into this zone. Now can enter the trade at the close of the candle. Another way is to use a limit order, for example at 50% of the zone. The stop loss, as I said, to the previous high, and the take profit here at the zone that we already identified. And you see the risk to reward is amazing. Even if we would enter somewhere like here, then it would be a 10-hour trade. Okay, so I'll play it out here on the 15 minutes, and you see we are reaching the take profit. Another more safe way to define the take profit is to use an imbalance. For example, at this candle you see a large imbalance, and for this strategy I will plan the take profit to 50% of this imbalance zone. These are levels that are reached pretty often. Alright, so let's go ahead and find 100 trades for a backtest. Okay, and now you see the win rate is not that high, but the profit, because of the high risk to reward ratios, is extreme. But I also found out that the losses I got most of the time because I was wrong by identifying the liquidity grab. Using the line chart can help, spotting equal lows or highs, and what's also important is the levels of liquidity should be significant. What does it mean? In this example, we have two equal highs that are also session highs of London and New York. Then we see the clear liquidity grab. The level is broken, but price comes down immediately. And then I switch to the 2 minutes time frame and the candlesticks, and use again the indicator to see the shift of the market structure and the fair value gap, the imbalance where I place my entry. So see here, this low is broken. A fair value gap is created with this relatively large red candle. And then I go short inside this imbalance, stop loss to the previous high, and I take profit at 50% of the imbalance candle to the upside. So guys, I hope you found this interesting and useful. If you do, then please don't forget to subscribe to the trading guide if you haven't already. If you have any questions, add these to the comments below. Also hit the notification bell to be notified when new videos are online. Follow me on Twitter, and I'll see you in the next one here on the trading guide.